Welcome to the TEK2day podcast, powered by CEO Rater. It's your host, John Maeda. Check us out online at TEK2day.com. Visit us at CEORater.com. Anonymously rate your CEO, rate your company. As I mentioned in episode 339, CEO Rater is going to be partnering with the J. David Group. J. David Group has an executive search operation for sales professionals, and we're going to partner with them, bring our unique data set to bear at CEO Rater in an effort to roll out a C-level executive search operation. And you're going to hear more about it in the second half of this year after we get through the toughest stretch of this COVID-19 virus. So stay tuned for that. An article that we published at TEK2day that gained a lot of traction was our article around Disney, specifically that we believe Disney ought to spin off its park business from its content business. And you can read about that. That's the most recent article at TEK2day. Our rationale for that is the parks business is what's dragging down the stock and what will always drag down the stock. Parks, by definition, isn't going to carry the valuation multiple that the content business would carry. So we believe that the media networks business, the direct-to-consumer business, the studio business, all the content businesses at Disney ought to be bundled into one quote-unquote content business. And you got to have two separately traded stocks, one for parks, one for content. And for precedent, you could look to eBay and PayPal, how they went their separate ways after much deliberation internally. You can look to John Malone's portfolio of companies at Liberty Media, where Liberty, over the past decade or more, has spun out a variety of businesses from Liberty Media that trade with their own stocks, their own ticker symbol. And then you could look to Barry Diller's family of companies at IAC, where IAC spins out companies. Once they have scaled and they're large enough to exist on their own as separately traded public companies, they do so. They allow them to thrive as separately traded public companies. So I think that by Disney spinning off parks, it will allow the content side to realize its full valuation potential over time. And so what we did in the article is we sort of comped Disney's content business to Netflix on a multiple basis and showed that what that content business could look like from a valuation standpoint, steady state as it scales. And what the numbers would bear, obviously, is that the content business, Disney's content business, is substantially undervalued. So that would be our bit of advice to Bob Iger as they work through COVID and get back to some normalcy on the operating side. The remaining months of Iger's tenure, which is he's spending exclusively, as you know, on the content side since he stepped down from the CEO position, and they could figure out, in addition to beefing up content, I expect them to acquire MGM Studios in the James Bond franchise. In addition to beefing up the content, corporate action around spinning out content from parks, I think, would be advantageous, not only in the immediate term once such a spin out were completed, but for sure over the longer term. That's all for now. See you all next time. Be well.